and welcome to this brand new edition of Mutual Fund Corner on CNBC-TV18. I'm Sonal Bhutra. With me, as always, is Pavitra Parekh. Hey, Pavitra. Well, we have been crunching the data down for Mutual Fund Corner in the month of June, and index funds, they did see an outflow. Yeah. So after inflows of around 147 crores in April, around 109 crores in May, it was an outflow of 906 crores in the month of June. We've been seeing large caps not doing so well versus mid caps and small caps, of course. So what is the outlook when it comes to index funds? To understand it in greater detail, that's exactly what we are going to do on the show today.
All right, so let's invite our guest then, and we can get to all of those questions. We have Chirag Mehta joining us. He's CIO at Quantum AMC. Chirag, thanks a lot for joining us and welcome to the show. So, like Sonal was pointing out, we've definitely seen money move out of large cap funds, out of index funds and into the small cap space. Do you think that trend will continue, and how do you read the flows in this space?
Sure. Thank you for having me on the show, Sonal and Pavitra. So if you look at exactly what you just said, that large caps have not been doing well as compared to mid and small caps, and we probably are seeing that rotation out of those large caps towards those mid and small caps. So if you look at index funds, usually they are large cap oriented, tracking the frontline indices like Nifty or Sensex. And therefore, given that the relative performance of mid and small cap is much better as compared to the large caps, we are seeing that shift. So at some point, there is some profit booking given markets are at record highs. But at the other end, there is a rotation that's happening from the large cap segments towards mid and small caps. So I think overall, we had seen a lot of flows coming to the passive investments over last 5 years. I think given that large, mid and small cap are relatively not doing well, looking a bit riskier, now with the pickup in the economy, broad-based earnings panning out for companies, and broad-based participation from companies as compared to the polarized performance that we saw for much of the period from 2017 to 2020. Now, given that we have seen surge in this segment, of course, backed by earnings of those companies, we are seeing participation also move. So if we see, the broad market performance continue from here, given that the economic cycle that we are in, probably this trend may stay for some time with us. At the same time, if you look at the large cap valuation is getting a bit attractive as on a relative basis as compared to mid and small cap. So if there were going to be a meaningful correction, you could see that rotation back into large caps from mid and small cap segment. But unless we have this broad recovery going on and markets continue to poise higher, that will drive flows more into mid and small caps.
Okay, interesting take there. And another record high for the markets today again, so it'll be important to track the flows there. But Chirag, I wanted to understand this move that we've seen, HDFC Bank and HDFC merger. HDFC has stopped trading from today. How has it impacted flows in index funds and generally equity flows? Do you think that'll have some impact? MFs will have to realign their holdings. Will it have an impact on July flows?
Sure. Let's look at first from the index fund point of view. So if you look at index funds, given both HDFC and HDFC Bank will now trade as HDFC Bank, that will lead to an increased weight. So you'll just add the weights of both that were earlier, and that will result into higher weight of HDFC Bank in the index. Given that one stock moves out, there is to be room created for the new stock that comes in. So LTI Mindtree kind of came in as part of the index as the 50th stock, and now there was a overall trimming of other stocks to make space for the 50th stock that came into the index. So there was a rebalancing, there was some trimming and adding a stock from the index funds. From the active space, if you look at so given that active funds cannot hold more than 10% in any stock, given the combined weight of say HDFC Bank combined into HDFC Bank will be close to 14%. That will lead to the funds not been owning more than 10%. So all those who had exposure to of more than 10% will have to trim and bring it down below the 10% mark. So that is the trade that we will see. I don't think from a flows perspective, you will see intra-stock, you may see some trades, but not from a flow perspective, it won't impact so much given flows from investors per se.
Okay, got that. And we're also waiting by to hear from the regulator, right, on how much time will really be provided to the mutual funds to balance, to rebalance on account of this merger. But Chirag, consider someone is looking at starting their investment journey now. Would you suggest that they look at index funds in this market setup? That's one question. And also, if someone is looking for a short-term kind of period, then what is your call? Should they still look at an index fund?
So, see, given the economic maturity that we are in overall, there is still a lot of room for active to do better than index. So if someone wants to participate in equity markets and have not earmarked the fund or the stock that they want to get in, till that time, from that perspective, they can, for a short term, tactically be into index funds. So that could be a rationale for that supports investment in index funds. But over a period of time, they'll have to find that great stock or fund that they should participate into. So overall, we have seen that if someone doesn't have time, knowledge, inclination of choosing funds or choosing stocks and does not have an advisor, they kind of move to participate in equity markets, which is a must for an investor. I think they kind of take root through index funds, and over a period of time, they mature and move into active funds over a period of time. And that is because there are so many opportunities outside the index as well, which kind of, as we have seen over last quarter or so, that really when there is a broad market participation from an earnings standpoint, much of the performance comes outside from the index. And when things are not so broad-based from our economic cycle perspective or the earnings perspective, then we see a lot of large caps doing better. So I think over a period of time, I think active still stands better over index funds given the opportunity set that exists in India. So tactically, if you don't have that, how do you want to participate and still want to be in equity markets, which you should be, then I think index could be a good starting point. Else, mutual funds do have a lot of solutions that have come out with, like, say, for example, equity fund of funds or advisors can help you to select the best funds out there. Then probably active funds will be better. So it depends on where you are, what stage you are, and depending on that, you could take your route to equity market participation.
Okay, so we'll come to that active-passive debate because that's been going on for a long time. Everyone has their own take on that. But before we get to that, you spoke about how there's a lot of opportunity that we're seeing in the broader markets, and we've seen that in the last couple of months as well. But what would be the benefits for someone who's investing in pure index funds, something that they think would be the triggers for them to go ahead and put their money there?
So when you are participating in index, the performance that you will get is just a replica of the index, right? There is no active selection risk that you get when you're participating in index. Whatever the market performance is, what you see in terms of stock market performance from the headline indices, that is what you will get as a return and risk along with your investments. But when it comes to one is no active selection risk that you get with index funds. Second is they are very, very low cost. They have very high liquidity. So getting in, getting out is very, very easy without much impact cost when it comes to index funds. And they are very, very simple to understand from an investor standpoint. As I said, that it will just replicate the index performance subject to tracking error and the expense ratio. So for an investor, they know at any point in time, if market is up by 2%, where their portfolio is going to be. So it's easier for any average investor or someone who's starting new to understand what their journey is going to be in the equity markets to some extent.
Oh,
so these are the main advantages when it comes to index funds.
Yeah, I mean, I completely take your point. For someone who's not sort of too well versed with the market, this could be a good way to, start investing. But Chirag, coming to my next question now, like Sonal was pointing out, this entire active versus passive debate has been going on. So take us through, if you have the data on this, what are investors really choosing? Has the passive allocation gone up? And what do you think is the right way to go about it? For example, we've spoken about how in several cases, large cap fund managers find it difficult to beat the index, right? For several rules that the SEBI has, of course. But do you think in those cases, then it makes sense to go for, a passive style of investing?
passive investing has picked up significantly in Indian markets over the last 10 years. So if you look at 10 years back, the share of active within the overall mutual fund pie was just about 1%. And from an investor's participation perspective, also it represented only 1% of investors in the overall mutual fund landscape. Now, passive as a bucket that I include index funds, ETFs, etc. That as a bucket constitute about 17% at a much larger pie of AUM. So today, the AUM is about 44 lakh crore, and 17% of that is passive. So overall, that has gone up nearly 17 times at a much larger base of mutual fund AUM. And from an investor participation standpoint, it represented just 1% of the investor base. It is now 11% of the investor base that exists in the mutual fund arena. So overall, from all standpoint, passive investing has increased many-fold. If you look at AUM of active also has gone up. But if you see from an investor or the share of active has remained very, very steady, nearly about 70% mark. So overall, passive have been hands down when it comes to active versus passive debate from a participation perspective. And much is also to do with the EPFO flows that come into index ETFs. So that has been a big boost for the incremental growth that we have seen in at least the AUM, not from investor count, but investor count has also gone up many-fold. When it comes to participation, so that we have clearly seen increased many-fold. But if you look at what caused that performance or participation increase was the polarization of performance that we saw. Large caps, there were a few stocks that drove the performance of large cap indices, and the broad market was not doing much at that point in time. So that drove really, that contrasting performance really drove the flows to the passive world, which is now kind of changing to a bit, given what we had was less earnings growth during that period from 2014 till 2020. Now we have good earnings growth, participation from many companies or many sectors of the economy, a broad-based earnings recovery, which is leading to that change in sentiment towards the active side and much towards the broader market as opposed to a few heavyweight stocks within the indices. So as polarization moves out, I think actives will do better. And within that, there will be broad market opportunities, which I think investors will get attracted to. And we may see some shift in the representation from investor side, like less flows may go to passives and more flows may go to active. So I think it's the rotation that we may see again from passive to active in some sense.
Okay, that is an interesting takeover backed by interesting numbers as well. Chirag, we'll continue this conversation, but we have to get into a compulsory break. We'll do that on the other side. We'll continue our discussion and understand in depth more about index funds.
Hey guys, welcome back. You're still tuned into MF Corner here on CNBC-TV18, and we still have Chirag with us to talk all about index funds. Chirag, we've gone through some of the benefits, you know, what the good part is for an investor who's perhaps just starting the investment journey as well. But do you want to take us through some of the risks associated, or, you know, if not risks, just some factors to consider before you invest in an index fund? And also, you could help our viewers with what the tax on this really looks like.
Yeah, so overall index fund from a risk standpoint, the biggest risk is tracking error, right? So tracking error is one of the yardsticks to measure the performance of any index fund or any tracking fund, be it an ETF or an index fund. So if the tracking error is large, means the fund manager is deviating from its mandate of generating returns in line with the index. So it could be that returns at the end point are in line, but it could be through a journey which is not in line with the index, which means that the fund will have a high tracking error, and therefore investors should be wary of those funds. So that's one of the biggest risks that one can come across. Second risk that could typically come with an index fund is, if the area of a market or a stock or a sector becomes expensive, or if there are, say, risks regarding governance, the fund manager will not be able to do anything till it is part of the index. The fund manager just mimics that index in the same proportion that makes the index. So I think these are the big two risks that one should watch out for. I think many pose that, liquidity being a risk. Typically, liquidity is not a risk because most investors in the Indian markets are not trading, even if it is index funds or ETF, they're not trading significantly, which may lead to lower liquidity on those counters. But there are market makers and there are regulations relating to market makers that kind of ensure that there is a buyer or seller to every trade. And therefore, one needs to look at what is the bid-ask spread, what is the impact cost, and whether there is enough depth that exists for them to get in or get out of that index fund or the ETF. So that is what typically one should look at. And I think I'll reiterate that the biggest risk from an index standpoint is the tracking error. So one needs to be very careful in the funds they choose. That tracking error has to be very, very minimal.
And that's important to talk about as well. So thanks for highlighting that. Chirag, so the main question remains, and that's what a lot of viewers are confused about as well. Is it a good time to continue looking at small or mid-cap funds versus, say, an index fund? You spoke about valuations, how cycles would turn. But for now, what would you suggest to our viewers?
Yeah, I still think that the economic cycle that we are in, the earnings cycle that we are in, there are many opportunities outside the index. I will not really say that, small cap is a place to be, because small caps at certain point in time can become a crowded trade, and there may not be too much liquidity that could, lead to that may impact the performance going forward. So from that standpoint, I think still the argument remains that there is opportunity outside the index. And therefore, given the economic cycle that we are in at this juncture, I think opportunities outside the index are better. So active funds will do well. Probably the kind of polarization that we saw isn't going to exist, the kind of cycle that we see. And therefore, one should take that opportunity. So far, if you have more exposure towards large cap or index funds or ETFs, I think it's the right time to make some shift towards finding good active funds and participating in them. I think the main opportunities, given the growth that we will see for the economy, and that should translate into meaningful returns or opportunities for sectors to participate in, which will drive the earnings growth. And so from that standpoint, staying in the active bucket is much more desirable. Plus, active gives you many opportunities to position yourself in the right manner. Like you spoke about mid and small caps, which could be some allocation of yours, but there could be niche strategies that they offer, like the value fund or the ESG fund, or there could be many other like the flexi caps, which kind of give you across the breed participation in equity markets, which is unlike in an index fund. They could cater to one side of the market, but a broad participation is what is needed at this point in time, which is well offered by the active space.
Oh, absolutely. And a lot of these flexi cap funds now have such a heavy small cap tilt, right? We were just talking to someone earlier on our shows this morning as well. And I think some 80% is in small cap sort of flexi cap fund. But Chirag, one final question. Every time, we talk about index funds, someone definitely asks us, how do I pick between index funds and ETFs? So, I get that there is confusion about this. Do you want to take us through how you would look at these versus each other?
Sure. So index funds are like open-ended funds like you have been investing into. They kind of take in your subscription, and at the end of the day prices, they will process your subscription and invest your proceeds into those index constituents. When it comes to ETFs, they kind of trade on the exchanges, as the name says, exchange-traded funds. They list on exchanges. You can buy them on real-time prices. So when say if the market falls by say 1-2%, and you want to take advantage of that price fall, you could participate well through an ETF as compared to an index fund, because you get the real-time prices. So when markets are down, you get that lower prices, whereas index funds will give you the end of the day prices. So that's a big difference between an index fund and an ETF. At the same time, if you want to do something like, say, for convenience, systematic investment plans, they are not really possible in an ETF structure. You have to go on your exchange, on your broking terminal every month and buy that same amount of index ETFs every month. Whereas in an index fund, you can do an SIP.
Okay.
So from that standpoint, I think index funds are better as compared to ETFs. But there is something called a fund of fund, which is an intermediary between an index ETF and an index fund. I think fund of funds on the ETF are a better structure. And from a tracking error, which we highlighted as the biggest risk of this space, I think ETFs will score much over index funds. So ETFs are more efficient products as compared to the index funds. So from that standpoint, I will go with the ETFs.
All right. Okay, Chirag, thank you so much for joining us. Definitely a masterclass in index funds today that we got from you. Thank you for joining us. Hope to be speaking to you soon again. And with that, we will wrap on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.